Namaste everyone. If you've been glued to your screens today, you already know we just witnessed an absolute roller coaster of a trading session on Dalal Street. Welcome to this explainer. I am your host, and today we are putting on our advisor hats to decode exactly what happened out there. We're going to track the massive institutional money flows pulling the strings, map out the crucial technical levels you need to watch, and dig into the actual fundamentals driving these wild moves. So grab a cup of chai, get your notepads ready, and let's make sense of this madness.
Now, before we get into the weeds, we have to address the elephant in the room, the million-dollar question. What on earth sparked that massive, sudden market surge right at 11 a.m.? We started with a gap up, sure, but then the market completely gave up those gains, leaving a lot of retail traders feeling trapped and anxious. And then, boom, out of nowhere, the bulls came roaring back. What was the actual catalyst?
Okay, let's dive into this. We opened with a gap up of 117 points at 23,530, tracking some positive global cues. But man, that first hour was treacherous. The index literally slid all the way back down to the 23,450 zone. But watch what happens right here, just after 11 a.m. Look at that vertical V-shaped recovery. This massive rebound was triggered by reports suggesting a possible tax cut on bonds for foreign institutional investors to boost inflows. And honestly, that rumor alone was enough to make the market reclaim 23,550 and surge right past 23,650 by lunchtime. We saw sustained momentum in the second half, with the index eventually closing super strong near 23,690. It was textbook Dalal Street volatility, a scary start followed by a very dramatic rescue.
Section 1. Sector rotation and outliers.
So the headline index had a wild ride, but we really need to look under the hood. An index is just an average, right? The real story is always told by sector rotation and the outliers. Looking at the sectoral performance next to today's top winners and losers, it's absolutely crucial to note the market breadth. We had 315 advances against just 184 declines. That is a super healthy advance decline ratio of 1.71. It clearly shows money rotating back into beaten-down pockets of the market after 4 straight days of relentless selling. Mid-caps even outpaced the large caps, surging 1.36%. And look at the outliers. NLC India absolutely skyrocketed, up over 14%. But on the flip side, Canes took a massive hit, dropping over 20%. We'll get into the actual fundamentals driving those specific stocks in just a minute.
And this brilliantly illustrates the massive divergence we saw across sectors today. I mean, 11 out of the 12 sectoral indices closed in the green, but the contrasts were just stark. Nifty Pharma ripped higher by a massive 2.74%, leading the entire charge. Meanwhile, Nifty IT was the major laggard, dragging the market lower with a 1.99% drop. This kind of sector rotation is completely typical when the market is trying to find its footing. Smart investors are basically moving money out of perceived expensive or sluggish sectors and parking it right into defensive or value pockets.
Section 2. Tracking institutional money flows.
Now, you and I both know retail traders don't move the market like this on their own. To really understand who was doing the heavy lifting during that 11 a.m. recovery, we need to track the smart money. Despite that massive intraday rally on rumors of bond tax cuts for foreign investors, the actual net flow data tells a pretty sobering story. Foreign institutional investors, the FIIs, are actually still heavily selling. Today alone, they offloaded a net of 4,703 crores. They've been consistent net sellers for the past week. So think about it. If FIIs are dumping shares left and right, who exactly was buying?
Well, here is the number that literally saved the market today. Positive 5,869 crores. That, my friends, is the massive net buying figure from our domestic institutional investors, the DIIs. Our domestic mutual funds and institutions stepped up and completely absorbed that foreign sell-off. They bought with incredible conviction, resulting in a combined net positive flow of 1,166 crores for the day. Make no mistake, this domestic liquidity is the true shock absorber of the Indian stock market right now.
Section 3. Mapping support and resistance.
Okay, keeping those money flows in mind, let's put on our technical advisor hats. We need to decode the derivatives data so we can map out the upcoming battlegrounds for retail traders and figure out exactly where the floors and ceilings are. Now, what's really interesting about this open interest or OI data for Nifty contracts expiring on May 19th is how it visually dictates the market's boundaries. The green bars represent put options and the red bars represent call options. As a general rule, heavy put writing acts as a base or you support, while heavy call writing acts as a ceiling or you resist. Let's break down where the big money is placing its bets.
Translating that complex open interest chart into crystal clear, actionable levels, Here is exactly what you need to write down. The maximum call open interest is sitting firmly at the 24,000 strike, with a very significant buildup at 23,800 as well. This means that the 23,800 to 24,000 zone is your major resistance. The market is going to hit its head really hard right there. On the flip side, the maximum put open interest is clustered perfectly at 23,500, closely followed by 23,400. So that 23,400 to 23,500 band, that is your rock-solid support. And honestly, that is exactly where the market bounced from today, completely confirming its strength.
Section 4. Fundamentals, Earnings and Inflation.
All right, let's pull back from the daily technical noise for a second. To be truly successful long-term investors, we absolutely must examine the lab results, the core, fundamental, and macroeconomic data that ultimately drives these market shifts over time. So here are the top domestic macro flashpoints you need on your radar. First up, wholesale price inflation. The WPI just spiked to 8.3% in April, largely driven by fuel, power, and crude oil prices. This is a big signal of renewed cost pressures in our economy. Second, to control food inflation and ensure domestic supply, the government has officially extended the sugar export ban until September 30th. And third, on the regulatory front, SEBI has proposed easing derivatives compliance norms to reduce operational burdens on exchanges. Rising inflation mixing with regulatory tweaks, it is creating a very dynamic fundamental environment.
And as you'd expect, that dynamic environment is reflecting directly in our Q4 corporate earnings, which have been incredibly polarized. For instance, NLC India, which we saw earlier, surged nearly 15% today to a record high. Why? Because their Q4 net profit jumped a staggering 189% year over year, driven by really strong margins. On the other hand, Tata Motors' passenger vehicle business saw a 32% profit decline. The so what here is that higher raw material costs completely offset their stronger sales. And Keynes Technology, our top loser today, slumped 17% after reporting a 22% fall in profit and entirely missing its own revenue guidance by 27%. The harsh lesson here? In today's market, earnings misses are being punished absolutely ruthlessly.
Section 5. The advisor's bottom line. So how on earth do we process all of this? The extreme volatility, the massive DI buying, inflation spikes, and wildly mixed earnings. Sometimes, to really ground our perspective, it helps to step back and listen to the wisdom of veteran management. Take this incredibly striking quote from Sunil Bharti Mittal, the chairman of Bharti Airtel. When talking about corporate capital allocation, he said, "We'll do dividends and buybacks, but we'll never become like IT companies that have done nothing but just taken money out and become a shadow of themselves." Wow, that provides critical context on why certain sectors stagnate. It reminds us, as investors, to look for companies that actually balance rewarding shareholders with reinvesting in future growth rather than just stripping cash out of the business.
And you know, if that 8.3% inflation figure or all the geopolitical noise out there is making you nervous right now, take a second to listen to veteran investor Prashant Jain. He recently pointed out this fantastic fact. He said oil was $10 or $20 in 2000. It went to $140 in 2007, yet your economy did well, markets did pretty well. That puts things into a whole new perspective, doesn't it? India has an incredible historical resilience to these external shocks. As long as our domestic demand holds up and our DIIs keep showing this kind of support, hitting the panic button is rarely the right strategy.
Which brings us all back to you, the investor. We've laid it all out today. The technical support levels you need to watch, the massive domestic liquidity holding the market up, and the undeniable fundamental pressures like that 8.3% inflation rate. The data is completely on the table. So, given all these conflicting signals, how are you positioning your portfolio for next week? Are you playing it safe and hiding out in defensive sectors like pharma, or are you looking at these intraday dips as an opportunity to buy high-quality names? Drop your thoughts and strategies in the comments below. I would absolutely love to read them. Thank you so much for joining me for this explainer. Until next time, trade smart and stay focused.